Welcome to the ninth session of Management Accounting, fifth semester of BBA Bangalore University. In this ninth session, we are going to discussing the limitations of ratio analysis. Recap of previous class. In the previous session, in the eighth session, we discussed what are the uses of ratio analysis. Limitations of ratio analysis, and they are false results, limited use of single ratio, absence of standard universally accepted terminology, ignoring qualitative factors, ignoring price level changes, misleading results in absolute data, window dressing, personal bias, incomparable, ratios no substitutes. Let's discuss one by one briefly. The first one, false results. The accuracy of a ratio depends on the accuracy of information derived from financial statements. If the statements are inaccurate, same will be the result with ratios. Limited use of single ratio. A single ratio cannot convey any meaning at all. Hence, some more ratios are calculated to know something from a single ratio. Sometimes the calculation of many ratios lead to confusion instead of helping the analyst to make meaningful conclusion. Absence of standard universally accepted terminology. There is no standard for any ratio. Only rules of thumb for all the ratios are accepted and followed till date. Hence, the interpretation of a ratio is difficult. Ignoring qualitative factors. Ratio analysis ignores the qualitative view of the firm and tends to include only the monetary aspect. Ignoring price level changes. When we are comparing period-wise numbers for trend analysis, and if in between the periods the inflationary rate has changed, the comparison makes no sense. Ratios analysis does not account for the inflation factor at all. Misleading result in absolute data. Ratios may make the comparative study more complicated and misleading conclusion on account of changes in price level. Window dressing. The window dressing of financial statements is very easy. If so, the weak financial position of the business concern may be shown as strong financial position. In such a situation, an analyst may take wrong conclusion and decision based on the calculated ratios. Hence, it is very difficult to an outsider to know about the window dressing made by the business concern. Personal bias. Different interested parties are using the same ratios in a different way. It leads to personal bias. Nobody compel anybody in the analysis and interpretation of ratios. Incomparable. Ratios will be meaningful if they can be compared with standards or norms. Except for a few financial ratios, other ratios lack standards which are universally recognized. Ratios no substitutes. Ratio analysis is just a tool of financial statements. Therefore, they are meaningless if they are segregated from the financial statements from which they are computed. Thank you. Have a nice day.